Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Michael Pouliot. He is the Chief Investment Officer at Carbon Real Estate Investments, a vertically integrated private equity company focused on workforce housing in the Southeast. With more than $1 billion in completed transactions, Michael blends Wall Street training through JP Morgan and Merrill Lynch with entrepreneurial execution to deliver value for his investors and empower the next generation of deal makers. Michael is also the host of the Deal Flow podcast. So, Michael, I'm looking forward to our conversation today. Welcome to the Wealth Flow.
Yeah, thanks for having me. I'm looking forward to it as well.
Yeah, me too. I do like to start with everybody's background, where you grew up and what eventually led you to become a real estate investor.
Sure. Yeah, I can start there. So, I grew up in the Northeast, right outside of Manhattan, and I was born to a kind of a real estate family. So you could sort of say that real estate is in my blood. My father's a builder, his father, my mother's father. So I grew up on job sites and started digging holes and leveling ground, as soon as I could legally work, just around, 12, 13, 14, somewhere around there. So I learned a lot about construction and site work and the smell of fresh wood and paint and things like that. So, but after that experience, I was like, you know what, this is not for me. Too many wheelbarrows, too much backbreaking work for me. And I decided to, get my undergrad in finance and find a career on Wall Street. So did that, went to school in Boston, then came back to New York and started working in fixed income primarily. And while I was there, I realized, hey, let me look at this real estate thing again, because I certainly seem to be trading a lot of time for money here. Is there a way for me to maybe find a way to develop some real estate so for cash flow and look for some financial freedom, some time freedom? And that's kind of how I stumbled on the first few transactions back in the mid 2010s.
Okay. No, that's very interesting background. And it's funny how sometimes we'll go a different direction and then get pulled back into the family business, it sounds like. So there you go. And so tell me a little bit about your real estate, right? So you focus on workforce housing. Tell me a little bit about that. Or is that what you initially did, or where there were several things in between there that kind of got your feet wet?
Yeah, so I did start in workforce housing, and that's been predominantly where I've spent most of my time. It always seemed like the place where, this is housing by necessity. This is the average or median income of, U.S., residents, so to speak. And it made a lot of sense to me. So my first few transactions were in Philadelphia. doing single family BRRRR strategies. So I would buy typically really distressed property. At that time, I could buy a single family home for 10, 20, 30, $40,000, totally, needing a gut renovation, but at least I could buy it. So I'd buy that with hard money and then fix it up and then refinance it, rent it out, and hold it. And those were all in C plus areas and passive progress, where I thought at that time the thesis was eds and meds. So where could I be near larger universities that were growing? At that time, that was Drexel and UPenn, and then the health systems in that area. If people have watched The Fresh Prince of Bel-Air, West Philadelphia, born and raised, I bought a lot of property in West Philadelphia, and during that time, it doubled in value. So it was I don't know if I would call it luck or skill or some combination there, but that was sort of the beginning. I did that, I don't know, 30, 40, 50 times over the course of a year or two. And then I said, hey, this is great, but I need to figure out how to do it at a bigger scale if I'm ever going to make the kind of money I was making in my W-2, which was the goal at that point. I sort of got the taste of it. And I said, hey, I want to figure out how I can make this into a reoccurring income that could replace my job, and I could do this full time. And but it took more than just single family to get there.
Okay. But it certainly gave you kind of the start. And for the audience, I mean, I think a lot of people know what the BRRRR strategy is, but can you go into a little bit more detail on exactly kind of what the process is in starting there? Because I think that's just a tremendous tool for a lot of new investors to be able to use. It's not rocket science, and it's an easy way to cut your teeth. And yeah, I shouldn't say easy. None of this stuff is ever as easy as it sounds, right? But it is a method that, when done right, certainly can help you build, that first $1 million in wealth, very easily.
Sure. And I would also note that the BRRRR strategy is a framework that can be applied to a $50 million transaction. It's just that, it's a great way to start, but it's the same strategy that we use today to execute for investors. So going back to one example, that first property I bought, for instance, was in Grays Ferry, which is in South Philly, and I bought it for $25,000. This was a 900 square foot, 2-bed, 1-bath row home, so pretty small property. And I bought it on August 15th of 2016. And I put $40,000 into it. So I was all in for about 65 plus another, say, $10,000 in transaction costs. So $75K. I was able to rent that property out for about $1,000 once it was all said and done. But the real trick to it was that initially I got a loan for that $75,000 essentially. And I think I only had about 10% equity. It was a go-go years, the mid 2010s. And so a lot of leverage. I was able to get, I think, 90% purchase, 100% renovation. So I wasn't in for more than, say, 10 grand on that deal. And then I went to a local, and that was with a hard money lender. So short-term, high interest rate. I believe at that time I was using Renovo, which is based out of Chicago. And then I've used Finance of America Commercial and some of the other kind of national lenders. But either way, did that. And then, went to my local credit union in Philly and said, hey, I got this property. It's cash flowing. And they're like, great. We love that. They're at credit unions. They want to invest in the local area. They valued the property at $125,000. They gave me $100,000 in debt on that. Rates were low. So that cash flowed for me, and insurance was low and taxes were low in this area. So I took out the full 100, even though maybe I wouldn't have done that today. I was a little over leveraged, but I took that out. And then I got my money back, and then another 25 grand right on top of the money I had in, plus the loan that I paid off. I had another 25 grand. So that allowed me to then do more and more and more over time. And I just rinsed and repeated that strategy, like I said, dozens of times over the following, 12 to 24 months. And it mostly, I would say 90% of the time, I would either, be able to refinance all of my equity out and then some, or pretty darn close. I think there was only one or two transactions where the appraisal came in and it was just like, geez, I'm going to leave some money in the property. Which isn't a
Yeah,
loss,
yeah.
right? It just means I'm going to leave some money in the property. I can't like port it to the next deal, which slows you down. And I was all about kind of speed of capital and velocity at that time. So, but yeah, that's how it all works. I think it's a great strategy if you can find distressed opportunities where you can really add value and leverage the bank's money.
Yeah, yeah, for sure. I mean, that's the biggest struggle with a lot of folks. It's just, if you look at doing it a different way where you're just saving up for down payments, that gets pretty, I mean, it just extends out the time frames, right? Where you're just sitting there trying to save up enough, make enough through whether it be your W-2 or whatever in order to buy that next property. And this just really accelerates it because like you said, you've only had a few deals where you didn't at least get your initial spend back out. And now all of a sudden you're ready to buy another property. So, well, cool. So you looked at that, you did that for a while, got some good experience with it,
Sure.
but decided you wanted to go from there to, I assume, multifamily. But tell us a little bit about that, that kind of next step in your journey.
Yeah, there was a bit of a transition there. One of the things I'll note that I think is helpful for folks that are doing the BRRRR is once I got that first appraisal, then I knew I was going to continue to be able to get really good appraisals from the same banks. And so I really tried to focus not on finding another deal 50 miles away, but focusing on that same area because I can then rinse and repeat. I knew the price I had to buy at. I knew what the renovation was going to cost, and I pretty much knew my exit value. And so all my numbers that are normally pretty high, risk execution wise, you don't really know what your appraisal is going to be. I knew a lot of those. So I was able to then very quickly do a lot more. And then the bank knew me already. So underwriting became a lot easier. Once you get that first deal done, sure, you've had people on who talked about the law of the first deal, whether that's their single family or their multifamily. Once you get that first deal done, the deal sort of just, you knock them down. So, to multifamily, though, when I was doing single family strategy, I ran across a few duplexes during that time, and I even found a couple single families that I was able to convert into duplexes based on the zoning, and those were like home run deals. Like I was able to buy them as if they were single family, but then they rented out as twice as much rent because I had 2 units, and so I was like, wow, this is fantastic. I need to start looking at where I could do more of this. So at that time, though, I was working in financial consulting, and I needed to figure out how I was going to do, and it was a pretty demanding job. I was traveling a lot, and how was I going to do both of these? So I started looking at doing some flips as well, and eventually, after doing a bunch of BRRRRs and a bunch of flips, all pretty much remote, I ran into money. Essentially, it was just like even though I was getting more and more, I was just putting it out faster than I could get it in, and finding deals was always kind of the strong suit. And so that's when I said, hey, I need to first I need to go into multifamily, and then 2, I need to find some partners who could bring the equity while I, find the deals and operate them. And so probably going to my 3rd year as a real estate investor is when I started doing multifamily, and I started joint venturing with folks where I found the diligence, the underwriting, the management, and they would come in and be that investor for us. Yeah.
So what was then your initial, first deal that you really kind of, beyond the ones that you converted, like, what was the next big step up, I guess?
Yeah. So my first larger or multifamily transaction was a 36 unit in the south side of Chicago. So somewhere where I think a lot of folks might say, oh, that's kind of a war zone. But I've always kind of thought of contrarian, thinking a little bit off the beaten path. If someone immediately has a sense of something, it's probably it's not the whole story. So when people hear south side of Chicago, they typically think of crime and maybe low values and maybe not a lot of opportunity. But I found enormous opportunity from, this particular property. I bought this one. It was 36 units, $25,000 a unit, pretty much all 2 bedrooms. The strategy here was to go from cash paying tenants to Section 8 tenants, where I could get a much more rent per room or per two bed. So I believe we went from about $800 two bedroom rents to about 1,300, and and 25K basis. I think we put about 25K into each unit. So you know that was a really good yield on investment. And I kept that property. That was the last deal I was able to do before I ran out of money. It required a lot of money. I also used a hard money for that, a loan for that as well. Obviously, I was like, hey, if I could do one, I could do 36 at the same time. It should be easy. And so we executed that. It took a little bit longer to get all those units done, and the city of Chicago is a little bit difficult to work with so far as permits and things like that. So it took a little bit longer to get that project completed, but great basis. We ended up selling that at a profit as we continue to kind of move up the property ladder.
Okay. Okay. No, that's very cool. Different way to structure it too with the hard money lender. On that one, did they give similar terms to what you were getting on like the single family? Were you looking at like a 12-month,
Yeah.
construction period, or
Yeah,
would they extend out?
I originally had, I think it was, I ended up flying to Chicago and having a meeting directly with the Harmony lender because they were like, who's this guy? I was living in Boulder at the time, Colorado, investing in the south side of Chicago, not having experience. And so I flew out there and sort of pitched like, hey, listen, I'm going to do this. This is going to be one of many transactions. Support me now, and I'll keep bringing more business. And so, but yes, it was very similar. I think we were paying two and 12. I was paying like 2 and 12 or 1 and 12, and then I got 24 months term. So yeah,
Okay. Okay.
expensive,
Fantastic.
expensive.
Yeah. Yeah. But you sold it, and you sold it for a profit. How long did you hold on to it before you sold that one?
So after the initial loan, we were able to then move that into agency. So we got out of the RMI loan, we refinanced into a small balance agency, Fannie Mae debt, and then held it for another year or so, and then sold it in 2019, 2020, something like that, pre-pandemic.
Okay. Okay. Yeah. Yeah. All right. Sounds good. And then, so that was your kind of your first, 30 unit plus. And then from there, what was your next purchase?
Yeah, so now that I had a case study again, similar to that single family space where I was like, hey, rinse and repeat. Well, let's go ahead and rinse and repeat. I had that case study. I could point to what is the construction going to cost? What can I buy for? What can I sell for? What can I appraise for? I knew all my numbers essentially. And I ended up doing about 300 additional units in that same area over the following 12 months, again, with joint venture partners and eventually a family office that ended up supporting a fair bit of transactions in the Chicagoland area after that.
Okay. Yeah, that's fantastic. And how about deal flow? What were you doing to find those deals? That's obviously a big jump to go from 36 units to then doing 300 additional units.
Yeah.
How were you finding these?
Yeah. So, this was mid 2010s. There was a lot of opportunity out there. We were primarily working with brokers that were the top brokers in the area. So, and that's still typically how I do transactions. Even if they're off market, there's typically someone who's been building a relationship with the owner for decades. A lot of times,
Yep.
the broker has sold the same deal 4 times before you see it. So, really leveraging those broker relationships, and it really cuts down on the amount of relationships you have to maintain as the deal professional. So there might have been 10 brokers in that area that controlled 90% of all the deal flow. And so I just had really good relations with them. I would, go to Chicago and have lunch with them, coffee, go tour deals. And most of those transactions were between, say, 25 and 75 units. And so that's a very specific type of broker that focuses on those types of transactions. And, it's different everywhere, but generally speaking, I've seen that 80-20 rule hold true. There's, about 20% of the brokers hold about 80% of the inventory.
Right. Yeah, no, I agree. And what about so these were all, like you said, was this was around the 2020 timeframe, or was this a little bit before that?
Yeah, a little bit before. So
Okay.
I moved from the kind of sub 100 units to the 100 unit plus in around the late 2018. That's when I started looking at, okay, where can we get more scale? Start thinking about on-site staff. There was a lot of attention to just as we were buying more, just the operations of properties and how inefficient it can be when you're using third-party management and you have smaller properties. There's just sort of seem to be getting raked over the coals a little bit as it relates to expenses, R&M, PM fees, things like that. So we said, hey, let me just start buying larger properties where I can hopefully control the OpEx a little bit better. And that's when I started buying, my first 100, plus property at that point.
Okay. And were you still focused on kind of Chicago area, or had you broadened out at all, or is that still where you're at today?
Yeah. So, I'm not buying so much right now in the Chicagoland area. I still like it, and I think that a lot of people have noticed since the peak that the Midwest is a great place to invest, and there's a lot more stability and maybe a little less volatility than the Southeast and the Southwest and some of the you know positive net migration areas that everyone was really into in the post financial crisis to about 2021. But I did buy about 1,000 units in the Chicagoland area between 2018 and 2021. And those are all really strong performing assets that have agency debt on them. The strategy did change a little bit as we moved up in size. We really thought about quality from a location perspective. So we went with older properties, but in really, really strong submarkets. So if you're familiar with Chicago land, Naperville, Glen Ellen, those types of markets where we have really strong schools, really low crime, great income and house value. And so we could provide, workforce housing in those communities for families that wanted, the best schools for their kids. And that strategy, bore out pretty well. And we still employ that same underlying thesis today in the Southeast, which is primarily we operate today.
Okay. And when you say Southeast, where in the Southeast are you really focused?
Sure. Yeah. Our focus is on Georgia, the Carolinas, Northern Florida, Alabama. Those would be our primary markets today that we have exposure in.
Okay.
And again,
that's great.
Workforce housing, high income, great schools. We're typically looking for 8 out of 10 or better on great schools. We're looking for flat or improving population and income growth. Typically, we're looking for incomes in the $60,000 or $1,000 income or higher. But most of the assets that we actually buy are usually $80,000 to $100,000 incomes, but we'll have dollar per square foot rents. So really affordable rents relative to really strong income.
Okay. No, it sounds like a good formula for sure. And so obviously you've grown quite a bit over the years. Was there anything that you noticed as you are kind of growing and getting into larger and larger units? You mentioned a little bit of some efficiencies with property management, and how obviously when you get above a certain unit level, some of those on-site management, that kind of thing, seems to make a lot more sense versus third party. But tell us some of the lessons and stuff that you've kind of learned and just through your own experience there.
Yeah, so it's there's a bit of a principal agent problem as it relates to property management. So I think the primary goal of fee only property management is to retain clients and to grow your fee income over time. And so profits at the site level aren't necessarily that important, only to the extent that it leads to a client leaving you, right? As now, I'm not saying that everyone has this incentive and that, maybe this is a little bit pessimistic, but we found in our experience that when we worked with property management firms, we were paying 3% of revenue. They weren't that concerned about driving top line, about controlling expenses, or really having like an ownership mindset. It was very much more of a, cover your, type of attitude, very risk averse, a lot of outsourcing of a lot of different things that we otherwise could just have done in house. And so that being said, there is a reality of scale. At a certain, you need to have a certain amount of scale in order to afford to have a property management company. So once we got to that scale, we did build out our own property management company that only manages our own assets. And so I know you might have noted that in the beginning, we are vertically integrated at this point, but we didn't start that way. We really started with fee managers all the way through 2021. And then as the market started to shift and there was a bigger focus on operations, it was more and more apparent that, we weren't seeing revenues grow 20% a year anymore. So a lot of those operating inefficiencies became more apparent. And we said, hey, listen, we just have to take over our operations, our construction, our contract services. And we've been doing that over the last 3 years, slowly taking over more and more of our properties and more of the what would normally be vendored out, right? Whether it's painting or turns or the construction process or snow, landscaping, things like that. And so we were able to control our expenses a lot more, and we're able to have much better communication, obviously, since everything's internal, which leads to, better execution for the business and then for our investors.
Yeah, that's great. And I think it's probably good that you started the other way as well. Then you can kind of see what you didn't like about having just third party management, and kind of what you weren't getting from them, and you could find the solution internally. And ultimately, you were able to scale up enough to be able to do it. So that's great.
Yeah,
How
just as a
about
quick example of where there's benefit there. When we were working with fee managers, if there was a HVAC system that went out, the go-to is replace, right? There wasn't a lot of thought around repair, especially some of these older units. I won't get into too much detail about HVAC, but there was basically older units are difficult to repair. It's a lot easier on the manager or the person managing the property to just replace them, but it's at an enormous cost, and also to vendor that out. So to vendor out a replacement versus to have your site team be qualified to do HVAC replacement is one thing. But we saw situations where we would have, say, a 200 unit property. We may have 20 or 30 HVACs that need to be repaired or replaced every single year, just as a normal course of business. And so that might be $4,000 a pop, but we could easily repair them and get another 5 or more years out of them for $500. And so, that's a $70,000 a year savings for 200 units. You put that over 2,000 and then 20,000 units, you're talking about millions of dollars of value, millions of dollars of cash flow. And it's just a decision that happens on the ground, and we're able to control. And that happens. That's just one example of dozens of examples of the same sort of philosophy of, hey, do the thing that's easy or makes sense as a fee manager versus, hey, this is our property. These are our investors. We own, obviously, part of the asset. We want to generate cash flow, and we want to, increase the value of the property. That was done through, being more efficient and making better, more cost-conscious decisions for the asset.
Yeah, that's a great example. And then what about on these? Has your, it sounds like at least in the initial ones, there was a lot of value add going in. What type of property, when you're looking at these, say, 100+ unit properties, what are you trying to find that you're able to go in and update or fix? Or tell us a little bit about kind of how your strategy works, and it may be different on deal by deal basis, but just curious to know kind of what you're looking for.
Sure. So we're generally looking to add value. We see that as a part of our downside protection, as if we can improve the yield of the asset. If the market softens, then we have more buffer in, a period of stagnation relative to rents. So that doesn't really change. Yes, the strategy on going in does change a little bit based on the situation and as the markets change. So in 2018, 19, 20, we are expecting, continued rent growth. There was proven value adds. Like it was something that we could just piggyback on maybe the other 6 or 7 people in the submarket that are already executed a very similar program so far as unit renovations, amenity improvements. As the market has softened since the peak, so far as rent growth, and you got to be a little more conscious of your expenses. A lot of properties have already gotten value add, maybe several times, maybe more than several times. And so it's not so much about improving the hard product, but maybe improving the soft product. Can you operate the asset better? Or the things you can do around expenses, or maybe the amenities need to be refreshed, but the units are fine. And so I think you sort of match where we are in the cycle, the submarket that you're in, and what the tenant or the resident base really is looking for and would pay for, and just be more conscious about that, because there's a little bit less room for error when the market isn't booming, which is kind of where we are right now. And so right now what we're finding is we're looking for opportunities where the prior sponsor has, maybe they're over leveraged, they're coming up to a maturity, there's some sort of usually partnership or operational distress, and we're able to therefore buy at a really great price, which we feel we're a long-term holder. So we're looking at 10-year plus horizons. We feel like right now is a really great time to be buying from a basis perspective, if you're going to be a long-term holder. So we're not looking to, hit a home run right out of the gate. We're really looking for, great basis plays in great areas, where we can operate better than maybe the prior sponsor, as well as reset that basis.
Okay. Okay. Makes sense. And what about just curious on this as well, because you've owned around the Chicago area. Now you're focused, Alabama, the Carolinas, that kind of stuff. Have you noticed anything? And you also rode some of this through kind of the COVID timeframe as well. Did you see any effect from a red state, blue state type thing? I mean, I've heard different things in different areas, and some of it's very specific to the county and whatnot. But did you have any issues with COVID and people not paying and having to try to do evictions and yada, yada, yada?
Yeah.
And do you notice a difference from that standpoint?
Yeah, there was definitely a difference between different markets and how the government reacted or handled evictions and tenant payment issues. And that being said, I think that was largely priced into the market. And so, people who like blue states, they like blue states for those reasons. And I try to step a little bit away from the politics of it, just because that's typically captured in the pricing already. And so, yes, it might take much longer to evict a tenant, say, in Atlanta versus Dallas or whatever you want to, compare it to.
Right.
But that's typically captured in 100 basis point difference in going in cap rate. So you're sort of paying for that efficiency, for that ability to turn over that non-paying tenant. And on the other side, what we did find is that, the properties that we have in the Midwest that maybe didn't run up as high as the Southeast or Texas, they didn't fall as far, and they weren't as over leveraged, and people weren't as aggressively bidding on them. So I think you see a lot less distress now in those, what I would say, like lower beta markets, where there wasn't as much capital flows, there wasn't as much liquidity, there wasn't as much exuberance in the Midwest versus, say, the Southeast or the Southwest. And I think people are being paid now for, their conservatism, whether that was in the Southeast or in the Midwest. So I would say it's relatively priced in. People know kind of what they're getting into, and we're still dealing with the challenges of that. So that's not saying that we could ignore those challenges, but they're sort of priced into our models, how long we expect an eviction to take, and we're still seeing delays on evictions in some of these areas.
Yeah. Okay. No, makes total sense. And yeah, I mean, outside of the politics of it, I just really was curious. Being in one of those areas or the other, you haven't operated in one and then said, "No, I'll never go back there." From that standpoint, it's more of a, hey, it's kind of, this is just what to expect when you're in this area.
I think, yeah, it's what to expect. We're more focused on the underlying fundamentals around the economy and the business environment, not so much as like the regulatory environment, as much as, do we see good migration? Is it affordable here? And do we see opportunity on the ground to buy at a good price?
Okay. That's fair. Makes sense. And then what about from a leverage standpoint? A lot of times the lifespan of an investor, it's you start out with as much leverage as I can get. And then as you get a little bit more experience, maybe going through a couple different cycles, whatever, and maybe that changes a little bit. So like when you guys are looking at a property right now, what kind of a debt structure are you looking at?
Sure. So we are entirely focused on agency financing. So if we can't finance it via agency debt, that's a pretty big red flag for us. Now, there are opportunities where it makes sense to use bridge financing because of the existing operations just don't support agency, but it shouldn't be an excuse to increase pricing, right? And so I think people were using bridge debt previously in the most recent run up really as a way to get more aggressive on pricing, even if the deal would have penciled for agency. So if it's going to pencil for agency, that's where we want to be. And there's plenty of opportunity out there right now where we can find stable assets where we can get agency financing. So fixed rate agency financing, we're typically going to be around, say, 70-75% loan to value on that based on where cap rates are and where interest rates are. And then we're bringing the rest of it so far as the CapEx and the closing costs all in cash, and obviously the down payment as well. And that typically means we're usually about a third equity and 2/3 debt when you put it all together. Maybe a little bit less.
Makes sense. Okay. Fantastic. And then as far as your team, you mentioned being vertically integrated. In any particular, key hires, things that just from a growth of your company standpoint that you've learned, as an operator.
Yeah, I think this is true for any business. And so we could replace the word real estate with any other type of business, but people are really the lifeblood and the driver of everything that we're doing. We happen to sell apartments for rent, right? That happens to be our product, but ultimately it's the people on the ground that are doing the work every single day. Our property managers, maintenance supervisors, our regional managers, et cetera. Those are the people that are actually, bringing the ball down the field. And so I would say the biggest wins from vertical integration have been being able to turn units much, much faster. That all comes down to the people and the systems and the dashboards that we have. But then also just having those shared services, having an internal HR department in recruiting. So we always have all of our, we use EOS as one of our operating systems. And so right people, right seats, making sure, and one of our, key, metrics is what percentage of seats are filled. And the goal is with EOS is 100% right person, right seat. And that's where we want to be at all times. And then we also want to have a bench of people for every single role at every single property so that if someone was to leave or if someone was to start to maybe not perform to their best ability, we'd be able to bring in someone else without being nervous about it. That was something that when we were with fee-only managers, it always felt that they were behind. It was very reactive as it related to the HR. They wouldn't really start looking for people until there was a vacancy. And by then, now we're well behind where we want to be. We want to be proactive with our people. And so I would say that's the biggest thing, being able to recruit our own people, having a deep bench of additional talent and making sure that we have a focus on keeping the right people in the right seats, highly motivated, well incentivized. That's the biggest one.
Okay. And then what about just the market in general? What are you seeing out there right now? Obviously there was this huge run up, kind of pre-COVID with cap rate suppression and just deal flow, or lots of deals happening, lots of transactions. Then that slowed down as the rates just completely blew up. And now they've really kind of ticked back down. They're not quite as low as I'd like to see them, but they're certainly not bad. I mean, it's like not a bad environment. It's just, it's taking a little while for everything to kind of settle where it needs to be. But what is your thought on the market in general and, what's your strategy for navigating that market?
Yeah. So, the real estate market, I think there was a something people were saying was survive till 25, right?
Right.
Or something like that, right?
Right.
I think that was a pretty generously long time scale from the peak, right? That was, 2021, 22 was the peak. So we're talking 2 or 3 years. But, real estate's a very slow, especially private, off-market, real estate where there's no ready, public marks. It takes a long time for deals to go from, highly levered with high interest rates to actually trading or getting to that distress. And so we are seeing some distress now, and I'm speaking specifically about apartments. Obviously, office is a different animal, data centers, like all these different industries or asset classes classes within commercial real estate have different drivers. But within apartments, we've definitely seen a slowdown in rent growth. So that's something we've got to be considering in the future. I do think it will reaccelerate as some of the new supply burns off and some of these concessions that I'm seeing in some areas burn off, but that's still probably 18 months away. So my view is we are at a time where if you are looking to put capital to work over a long time scale, 10 years or more, even maybe 5 years, I think this is a great time to be putting money in the ground so far as buying workforce housing. And, I haven't seen prices at this level since 2015. So I'm able to buy in really great areas at the same price that I was able to buy in the mid 2010s. And obviously rents have moved up 50% since then. So from my perspective, that's a win. And interest rates are relatively consistent with where they were in the mid 2010s. So are cap rates. So we're seeing cap rates in the 6 to 7% range. We're able to finance at 5 to 5.5 with agency debt. And that gives us a great spread. It means we're going to get a 5% yield out of the gate, quickly moving up to double digits by the end. By the time we've executed a value add, typically. So much different environment, not as much rent growth, but much better valuations going in, which I think is more important than getting rent growth in the future.
Right. Okay. And then what about just your portfolio in general? Right now, what do things look like? How many units do you have under management? How many what's the asset value under management? And then what are you seeing over the next, call it 3 years, as far as your strategy, more short term, I guess,
Sure.
as to how you'd like to see that grow?
Yeah, so within the south, within that southeast, we've got about 1,500 units. Let's say about 200 million, maybe 250 million dollars on the management, depending on where the 10-year Treasury sits, and then where the values are exactly. And our goal, each year is to buy 3 to 5 assets that we feel like will be complementary to our existing business. As a vertically integrated shop, we're very focused on making sure that we're buying in areas we already own, so we can continue to get scale and the benefit of that vertical integration. So we're continuing to build out a presence in Northern Florida, in Alabama, in Georgia, primarily. And so I'd like to pick up another 500 to 700 units next year, which would be pretty consistent with our deal flow every year, since 2017, 18.
Okay. Any particular cities in, say, Alabama and Georgia that you focus in or look at, or just the state in general?
Sure. So I think with Georgia, I would look at it as Atlanta versus ex-Atlanta. So within Atlanta, I like the northern suburbs primarily. Not all of them, as a blanket statement. We very much have a kind of quantitative overlay down to the 1 mile radius. So we're very much looking at the demographics within that 1 mile. And so even in one individual city or a zip code, one area of the zip code may funnel to a different school district than another. So we're very focused
Right.
on hyper focused on the submarket, which I think with the 2021 run up, people got a little bit over their skis so far as, Atlanta is amazing. And we can, look at the general trends of Atlanta. Well, it's a big difference between North Atlanta and South Atlanta. And then within each of those areas, there's a big difference between one city and another and one zip code to another. So we're really focused on that. But if I was to say generally Atlanta, I want to be in North Atlanta, and I want to be a little bit cautious about supply. As a big issue there. And then ex-Atlanta, I want to be coastal. I love coastal Georgia. For us, when I say coastal Georgia, I mean the same way as an insurance company would mean it. So 100 miles or closer to the water. So really like the Savannahs, the Augustas, the Brunswicks of the world, where we find that again, it's near the water, but it's affordable. Relatively speaking to a lot of other areas where you'd be on the coast. So I like that. We also have some assets in Middle Georgia that we really like, just as it's a transportation corridor. So we see a lot of flow from, just trucking and things like that down to Florida. And then in the Florida area, we really like the Panhandle area and then the Space Coast area. So if we're on the east coast of Florida, we're looking at the Space Coast. And then if we're, kind of, I guess, on the west side, so to speak. We're looking at Panhandle, Panama City, Pensacola, those areas where there's still some decent affordability, but people want to live there. We're seeing still good trends, and we're not seeing the same issues that maybe is popping up in like a Jacksonville and some other markets in Florida that are having some issues around supply and pricing. And then if I was to move into Alabama, we like the Birmingham MSA, not necessarily the city itself, but there's some suburbs in that area. Again, we are focused on schools. So first and foremost, if you're not hitting 8s, 9s, and 10s for schools, we're throwing that out. That typically eliminates 80 to 90% of all zip codes in the United States, which allows us to really focus down. But yeah, we like Birmingham. We're going to continue to buy there. And then I like the other areas of Alabama as well, but we just haven't gotten found the deals yet that we really like. Yeah.
Yeah. Okay. No, that's great. Good information for sure. Well, Michael, this has been great. How can people find out more about carbon real estate investments, and if there's anything also that you wanted or hoped to cover that we didn't get a chance, please now would be a good time to let the audience know.
Sure. Yeah. So if someone wants to just keep up on commercial real estate and what we're doing, go to investwithcarbon.com. We have a newsletter that we put out every single week. As you mentioned earlier, we have a podcast where we do interviews with capital allocators, other sponsors, family offices, and vendors in this space, as well as some of the adjacent commercial real estate spaces. I also do a daily podcast on commercial real estate news. And so if you're looking for just to consume more information about the market, that newsletter is a great place to go. So we'll link down maybe in the show notes to that newsletter specifically, but if they want, they can also navigate through that website, investwithcarbon.com. And when they join that list, they'll also get offerings from us periodically, not that often. We don't have offers all the time. And of course, most of our offerings are for accredited investors. And I'm not soliciting anybody. Solicitation can only be through a PPM, blah, 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 blah.
Got it. Now, I appreciate it, Michael. This has been awesome. I'm going to end with two questions I ask every guest. One would just be, any advice you'd give somebody who's maybe just starting out in their investment journey. Yeah.
So if you're just starting out on your investment journey, I think, like I said, people, everything is down to the people. So, and this is a people business, and this is a business you cannot really do on your own. So, I would be very thoughtful about how you partner with people, who you partner with, and who you work with, because those people are going to a lot of times make or break projects or, your business. And then otherwise, I'd say now is a great time to start in this business. It is a little bit of a challenge on the capital raising side versus maybe 2020 maybe not 2020, but maybe 2021. But the assets are there, the basis is there. And so if you can figure out a way to kind of claw your way into transactions and have assets working for you, I think you're going to be really happy, and that's going to be a great a fertile ground for your business in 5 years, 10 years, because this is a long-term business. So don't think you're going to make all your money in 12 months here. This is a generational type business, and now's a great time to be buying, in my opinion. And I don't say that all the time. Yeah. So I know probably people come on here and say every year is a great time to buy, but that's just not true. There are times when it's good to buy, and there are times when it's maybe good to just hold. Right. Not necessarily, we're not really sellers of real estate. We don't necessarily want to buy at above intrinsic value, right? And so we feel like right now we're able to buy below intrinsic value over the long term.
Yeah, I think that's great advice, and I agree. It's not always a good time to buy. How about a book recommendation? Doesn't have to be real estate related, but it certainly can be. Just something you've read that's been impactful.
Sure. So I've been I'm looking at my Audible here, and so most of, I guess, the ones that would be the most impactful, it's hard out there. It's hard. There's a lot of great books. I don't, I would say Think and Grow Rich. I'm sure I'm one of like the 50,000 people who maybe say that, but Think and Grow Rich is a book that I try to read anytime I'm trying to go from wherever I am to maybe somewhere I haven't been there before. Same with like Thinking Big is a great book, and so just these mindset books that can really shift your perspective. There's not all that much to real estate. I mean, you're going to learn it all in that first year so far as the subject matter. You'll learn a little bit more, but it's really your mindset that determines your success in real estate or any business. And so focusing on, keeping your mind clean, getting good sleep, eating well, and keeping positivity, not to the level where you're delusional, but positivity, because you're going to run into challenges. That's sort of the name of the game. If you're not running into challenges, you're probably not going where you want to be going, and you're not growing, and you're not creating new opportunity for yourself. So know that when you have those new challenges, if you read these books, you keep yourself you're marinating in these good ideas, you can typically get through anything. And that's the name of the game, is just keep on putting one foot in front of another, and you'll get to where you want to go.
Yeah, that's great recommendations there on the books, and totally agree. Yeah, at the end of the day, it's all mindset. So, well, Michael, this has been awesome, man. I really appreciate having you on The Wealth Flow, and I think we'll call it a show.
Excellent. Well, thank you so much, Keith. I appreciate you having me on.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.